Retail investors are back. Not only were we thrown back in time when Roaring Kitty was back on Twitter and we experienced yet another meme stock craze. No. On top of this, last month we saw something really interesting in US stocks. A surge of retail investors diving into US leveraged ETFs. But what does this actually mean and why should you care? Well, in this video, we're going to take a look at the numbers, uncover the hidden risks of leveraged products, and explain why leveraged investing may not be what you think it is. And I think you will be surprised. So without further ado, let's get started. Alright, hi there, my name is Renee, and let's start by taking a look at the numbers. So I came across this very interesting Financial Times article, and in it, the following chart was included. So what you basically can see here is the net purchase of leveraged equity ETFs, so that's stock ETFs, by retail investors over a rolling 1 month period. And essentially what the data is showing is that retail investors have been pushing around $5.2 billion into the 22 largest leveraged ETFs. And I guess we should kick this video off by first explaining what a leveraged ETF actually is and how it works. So a leveraged ETF is basically a tool, an investment tool that is designed to magnify returns, the returns of the underlying asset. And that underlying asset can be a bond, it can be a market index, can be a commodity, you name it. But unlike a traditional ETF that tracks the performance of the underlying index by a ratio of 1-to-1. A leveraged ETF will use financial instruments and debt to aim for a higher ratio, a higher multiple, such as 2-to-1 or 3-to-1, which are the multiples that are most commonly found in financial markets. So these ETFs, they basically have leverage built into them. And one example would be the S&P 500 2 times leverage daily index. And I can show you a list of leveraged ETFs that I found on justetf.com. So again, just to clarify what a ratio of 2-to-1 actually means. If the underlying index goes up by 10% during a day, the 2 times leveraged ETF would be up 20%. And conversely, if the underlying index goes down by 10%, the leveraged ETF would be down 20%. And obviously, a 3 times leveraged ETF would be down 30%. So just to be clear, leveraged ETFs, they also magnify losses. And to maintain the target leverage ratio, a daily leveraged ETF will rebalance its holdings on a daily basis. Now, with the explanation of what a leveraged ETF actually is out of the way, let's focus on why we saw such a significant inflow in the month of April. Let me just quote from the Financial Times article here. So the author writes, "The inflows marked a reversal from the first quarter as investors pulled money out of passive funds, while the benchmark S&P 500 repeatedly hit record highs. But fresh tensions in the Middle East and uncertainty about the path of US interest rates acted as a quote-unquote catalyst for investors to snap up leveraged ETFs, quote-unquote, to speculate on the market falling or hedge long exposures," said Ben Slavin, global head of ETFs at BNY Mellon Asset Servicing. Now, obviously, the authors will also have to speculate what was actually driving the inflows into these leveraged products. But if we take what is written here for granted, we can see that the factors that are driving this inflow are more short-term focused, not really related to the fundamentals of the underlying companies of the ETF, assuming it's a stock ETF. And in this context, I wanted to share this graphic here that I created quite a while ago that shows what investors should actually focus on. So I think all of these short-term factors that are not related to company or industry performance, so that would be elections, interest rates, geopolitical tensions, well, all of these factors, they are pretty much irrelevant for long-term investors. And long-term investors, they should rather focus on the quality of the assets they own, and if we focus on stock ETFs, the quality of the businesses they own. And obviously, quality is a very nuanced concept that consists of many underlying factors such as management quality, the growth runway ahead of a company, management incentive structures, the debt a company carries, the return it earns on future investments, and so on and so forth. And all of these factors, they seem to play no role when it comes to leveraged ETFs because, again, to quote from the Financial Times articles, what the retail investors are presumably doing here is they are trying to time the market, which, as we all know, is a losing strategy over the long run. So let me just quote from the paper again. Market timing is often the Achilles heel of day traders, and this time was no different, said Brian Armour, Morningstar's Director of Passive Strategies Research. Quote unquote, most of the top ETFs by March and April inflows had their worst monthly performance of the year in April. So that's actually quite funny. So seemingly those who were betting on a leveraged ETF presumably lost money because, well, they timed the market quite poorly. And this already illustrates that leveraged ETFs, they come with significant risks. Of course, if things go right, they also offer a lot of upside, but this instrument should definitely be considered a double-edged sword. Of course, if the market moves against you, a small movement in the market can actually lead to significant declines of the leveraged product. And that's why if you look up, for example, leveraged ETFs available to European investors on justetf.com, the following disclaimer actually pops up. I'm just going to read it to you. Disclaimer: short and leveraged ETFs have been developed for short-term trading. There you have it, and therefore are not suitable for long-term investors. Before you decide on investing in a product like this, make sure that you have understood how the index is calculated. Be aware that for holding periods longer than 1 day, the expected and the actual return can vary, I think that's a spelling mistake, significantly. And I think this disclaimer includes an important note. I think the biggest risk of leveraged products might not even be the fact that they both magnify wins and losses. I think the biggest risk is that investors who invest in these products, for the most part, do not understand how the products actually work over longer time periods. Because I would argue that even without adding leverage, most people cannot really comprehend how compounding works over longer terms. And as explained, these daily leveraged ETFs, they actually compound on a daily basis. And if people already struggle with comprehending how compounding works regularly without adding a multiplier on it, well, once you add a multiplier, things get really confusing, and I myself struggle to truly comprehend what is going on here. And this is also why, to quote from the article again, the US Securities and Exchange Commission last year warned investors that over long periods of time, the performance of leveraged and inverse ETFs could differ, quote unquote, significantly from the product it tracks, especially in unstable markets. They have the potential to create, quote unquote, significant and sudden losses, it added. Yeah, and I've actually stored this illustration with 3 different examples on my computer because it highlights how over the long term or over longer time periods, I think in this instance it's a 22-day period, how will leveraged products affect the actual return. So I would suggest you pause the video and take a look at all 3 examples yourself. I'll just go through one of them here. So if we focus on a market that is trending upward, that's the column on the left. So it's actually an 11-day period, not a 22-day period. Well, the index over that period increased by 2% each day. And I would argue the average person would now assume, well, after 11 days, the index will be up 22%. 11 times 2%. But that's already a mistake because that's not how compounding works. Due to the nature of compounding, the actual return, the cumulative return will actually be 24.3%. Now, if you add a 3x leverage multiplier on top of that, the expected return is neither 66%, which would be 3 multiplied by 22%, nor is it 72.9%, which would be the cumulative return of the index multiplied by 3. No, it differs because of the magnifier and the fact that the leveraged product is compounding on a daily basis. So the cumulative return of the daily leveraged product would actually be almost 90%. And as we have explained, this is great in up markets, but it works similarly when markets are moving down. So please be aware of that. And things get really complicated once we get to more volatile market environments. That's basically the explanation you can find on the very right in this illustration. And maybe just to provide a real life example here, when I was doing some research for this video, I actually watched a video by fellow finance YouTuber PensionCraft. He did a video on leveraged ETFs himself. And in it, he actually looked at the S&P 500 over, I think it was like a 5-year period. What you can see here in this illustration, I just took a screenshot of the video, is the performance of the S&P in red. Then in green, you have the 3x leveraged ETF that is compounding daily. And then in light gray, you see the performance of the S&P 3x cumulative ETF. So that's a different product. And as you can see, the performance of the daily leveraged 3x ETF differs significantly from the cumulative 3x ETF. Now, what I should say is that I do understand why it can be very tempting to make use of leverage, because after all, you can magnify your wins. And I think that's particularly tempting once we come from a period where, well, the market has been trending upward, where we didn't see much volatility, no major losses over longer periods of time. Of course, if you used a leverage product over that period, chances are you will have magnified your returns. And I guess one psychological bias is at play here, the so-called recency bias, which basically highlights that human beings tend to place more emphasis on the more recent past than over longer time periods. And I think in a way we are during such a period because over the last 3 to 4 years, basically ever since the pandemic, we didn't see major drawdowns of the S&P 500. And that's particularly true for 2024, as this graph here highlights that basically shows the maximum drawdown of the S&P 500 index, the S&P 500 ETF, I should say. Now, when we are talking about the underlying reasons for the significant inflow into leveraged products in April, I think we also have to bring up the casino mentality that many retail investors in particular adopt. They're not really investing, no, they are treating the stock market like a casino, a place that allows them to get rich quick, but also that can lead to significant losses. And let me just share a rule of thumb here that I think is true and that you should adopt and internalize as well. I think in investing in particular, the fastest way to actually go broke is to try to get rich quick. And instead, you just want to stay calm and patient and just be happy with the fact that you are able to compound your money over the long term. There's this wonderful quote by Andre Costolani. He once said, "I can't tell you how to get rich quick, but I can tell you how to get poor quick," namely by trying to get rich quick. And that's also the conclusion of the Financial Times author, because in the article it is also highlighted that they think investors who use these sorts of instruments to, and now that's the highlighted part, chase potentially large short-term returns are inherently much more susceptible to equity pullbacks. And what I will show you here is that on Reddit, you will every once in a while see posts like this where people who are treating the stock market like a casino, they are experiencing significant losses, possibly life-changing losses depending on their life circumstances. And I really want to caution you to not treat the stock market as a casino. No, treat it as the, well, best wealth-building machine out there. Basically, you can throw in $1 and you're almost guaranteed that, say, after 20 years or more, that dollar will be worth significantly more. But you can only make use of that wealth building tool if you actually treat it as a long-term wealth engine. So my advice to you would be that if you do the math and think about the stock market in a long-term way, I think you are destined to do very well financially. Just try to get a decent return, keep doing it year after year, and I can almost promise you that you will do very well 10, 15, 20 years from now. Don't make use of fancy instruments, don't short, don't use options, don't use margin, don't rely on chart patterns. And first and foremost, don't try to time the market based on short-term factors as highlighted in the illustration I showed you earlier. Instead, buy great companies, maybe just buy an ETF and then just wait. And finally, I maybe should highlight that I think whenever we are in a period where things get a little crazy, we just talked about the meme stock 2.0. I don't know, maybe it was a 2-day phase after Roaring Kitty posted on Twitter after I don't know, 3 years of retiring. We don't even know if the account has been hacked or not. And now we see this inflow into leveraged products. Well, whenever we see retail investors start speculating more and more, I think we are starting to get into an environment where the risk of a major pullback is increasing. Okay, let me just wrap it up here with a quote from Howard Marks. He said, "In addition to magnifying losses as well as gains, leverage carries extra risk on the downside that isn't offset by accompanying upside, the risk of ruin." Okay, that's it. Take care. Talk to you soon.